All right, let's go to Stephen Nash, who joins us now from FIIG Securities. Stephen, give us an early view and insights into that issue that's just been talked about this morning from Westpac. Do you think that's good value?
Look, I think given that we've had quite a contraction in a lot of credit spreads at this point, it's looking a little bit on the expensive side, but you know, it's a question of whether you think credit spreads have got further to go. I think what the issuer is looking at is that these costs of issuance have declined dramatically over 2012 and are now taking advantage of much tighter credit spreads and offering a security which I think will be quite successful in the market, given it is quite a wide spread. People will be looking at the name of the issuer and the spread, and I imagine it'll go quite well.
What do you make of the call date relative to the rest of the hybrid market as well, Dr. Nash? Because this is, of course, a new issuance, but there's a lot of kind of a backlog, is there not, more broadly, if we even kind of move beyond banks? And 2015's been cited as a significant test for this market, 10 billion euro actually piling up. Is that going to be actually called, in your view?
Look, I think in terms of the Australian banks, they're in a very solid position. Westpac are really doing this issue for a very sound reason, in order to top up that Tier 1 level, and I think they're looking quite good relative to peers. The Australian banks looking very solid relative to a lot of major corporations and banks globally now. I don't think there's going to be a major issuance problem for the banks. I think they have to get moving on some of these issues now, and that's exactly what they're doing. We've seen some senior issuance by the banks, and for them to offer other securities is a logical development, given that we've had such a large contraction in credit spreads of late, and that's also to do with equity markets being quite buoyant.
Yeah, and as you said, then it's a question of whether that all continues. If you do see a correction in equities, how would say these hybrids actually, behave in that environment?
Well, the Tier 1s will tend to generally follow more the equity movements. So these securities really won't provide that much diversification for your portfolio. We'd probably recommend more basic fixed income securities to give you much more interest rate risk at this time. With 10-year bonds at around 3.5%, if we do get a cut in the cash rate to around 2.5%, those Commonwealth 10-year bonds could rally substantially from here. These Tier 1s will probably not participate in that rally, so from a diversification point of view, probably more straight up and down fixed income would be appropriate at this point, I would have thought.
Is that partly due to the fact that they are so deeply subordinated and the interest payments can be deferred?
Yes, these are very deeply subordinated. You can compare them partly to the previous issue, the lower Tier 2 that was issued last year at spreads now around 180. These are higher in spread because they're a riskier security, and that's why Westpac are offering this extra spread. Obviously, Westpac is a very solid credit. We don't have any problems with Westpac as a credit, but they have much more risky characteristics compared to the securities that were issued last year.
Stephen, just a final question from me anyway. You just talked about potential for more rate cuts.
Yeah.
If we get more rate cuts from the Reserve Bank, there's been a bit of commentary around about, there would be almost no excuse for the banks not to pass all of that on. They'd be laughing all the way to the bank, because I think, one commentator in the SMH said. What is your view on the pass-through of funding costs to mortgage borrowers?
Look, we've had quite a reduction in funding costs for the major banks in 2012. It's quite dramatic, really. There has been some discussion about an independent rate cut by the banks, but I think the banks are facing extra regulatory costs. As was pointed out late last year, the CBA getting towards that 100 billion mark is a very large global institution. They will face extra regulatory costs. It will be difficult for the banks to do an independent cut, but I think, yes, another cut should be passed on in full, given the improvement in funding costs. And I think it's to be expected. 25 points should pass straight through to mortgage variable rate. Yes.
Haven't heard that one mentioned or with a straight face for a long time. Stephen, thank you so much.
Okay.
Dr. Nash from FIIG.